This voice is taken from an article with the title, How to Handle Gaps and Slippage During Rollover Periods for Effective Risk Management, which has been published on TraderTalks.net. Gaps and slippage are two common issues that Forex traders encounter during rollover periods. Gaps are the gaps that occur in a currency pair's price chart when the market opens at a different price than it closed the previous day. Slippage is when a trader's order is not filled at the requested price, but at a different price. Both of these issues can be caused by a variety of factors, including economic news, market volatility, liquidity, and the difference in time zones between the broker and the exchange. As such, they can be difficult to predict and manage. However, there are some steps that traders can take to effectively manage the risk associated with gaps and slippage. The first step is to understand the rollover process. Rollover occurs when a currency pair moves from the current spot rate to the next spot rate. This is typically done at the end of the trading day. During this process, the trader will usually incur a rollover charge, which is calculated using the current spot rate, the differential in interest rates between the two currencies, and the number of days until the next spot rate. The second step is to understand the impact of news and market volatility on the rate of the currency pair. It is important to be aware of any upcoming news that could affect the rate of the currency pair, such as an economic announcement or a rate change from the central bank. Similarly, traders should be aware of any market volatility that could impact the rate of the currency pair. This includes any large or sudden movements in the market. The third step is to understand how liquidity affects the rate of the currency pair. Liquidity refers to the number of buyers and sellers in the market. If there are a lot of buyers and sellers, the rate of the currency pair is likely to remain stable. However, if there are fewer buyers and sellers, the rate of the currency pair can fluctuate significantly. The fourth step is to use a stop-loss order to manage risk. A stop-loss order is an order placed with a broker that will close a position if the rate of the currency pair drops to a certain level. This can help traders to avoid large losses if the rate drops suddenly. The fifth step is to understand the difference between the time zones of the broker and the exchange. This can affect the rate of the currency pair, as the differential between the two time zones can cause the rate of the currency pair to move before the market has opened. Finally, traders should always use a risk management strategy. This should include setting a maximum risk per trade, setting stop-loss orders, and diversifying their trades. By following these steps, traders can effectively manage the risk associated with gaps and slippage during rollover periods.